So welcome everyone to yet another webinar being hosted for you by Get Set Up. We'll just get into it in a bit, but for everybody who's joined in, today we're going to be talking about asset allocation strategies for financial security post 50. We have an eminent speaker once again. I'll just give you his background in a bit. But what we'll be doing today is learning about asset allocation strategies and emphasizing on the importance of diversification and risk management across the investment portfolios. What we'll also be doing is we'll understand the various asset classes and how to allocate assets effectively across various categories such as mutual funds, stocks, bonds, fixed income, real estate, any others. And what also we'll kind of cover is something about how to optimize and focusing on a balanced risk and return to ensure there's financial stability and growth during your retirement days. The class is brought to you, and this webinar is brought to you by Get Set Up. Many of you who are already regulars and familiar with Get Set Up, welcome back. For some of them who've joined for the first time ever, just a quick background on Get Set Up. We are on a mission to help those over the age of 55 learn new skills, connect with others, and unlock new life experiences. Our goal is to reduce isolation, loneliness, and equip everyone in the community with tools and knowledge to age independently in place. Our community engages in classes online as well as through offline activities, simply like traveling together over a day trip or longer. It's one of the largest communities of active agers and older adults in India. So if you're not a regular community member, urge you to come and engage with your peers, learn from your peers, socialize and connect, and effectively age well in place. The class that today we're going to be covering about asset allocation has been brought to us by Franklin Templeton. Franklin Templeton is one of the largest asset managers in the world with over 75 years of experience, which they're currently managing about US dollars 1.4 trillion. And it has been part of the mutual fund industry for close to 27 years. And in the Indian industry, they've been managing about 78,000 crores. Franklin Templeton in India offers a diversified bouquet of products spanning equity, debt, and hybrid and international funds as well, which can help meet various financial goals and objectives of investors. They have a rich history of being pioneers in many ways, like introducing the concept of SIPs in the Indian mutual fund industry. The global parentage and local market experience position them uniquely to deliver value to the investors. Now, coming on to our eminent speaker, Mr. Sridharan. Welcome back. You and I have been having many conversations over the last many webinars together. So thank you for being a partner to Get Set Up. Mr. Sridharan is an eminent financial planner. He's the founder of a financial advisory firm called Wealth Ladder. He's a recipient of Associate Financial Planner, and he's got that title from the Financial Planning Standard Board. He's a very active contributor to specialized financial services magazines or TV channels like moneycontrol.com. He writes regularly at UTI Swatantra or Nayanam Viktam. He's worked across the financial services in many companies, and he conducts regular retirement planning across major public sector banks like IOB, Bank of India, etc. So, Mr. Sridharan, welcome again. And we'll cover a topic of how to allocate assets efficiently to both manage risk and returns. But interestingly, before we head into the interesting topic itself, let me just remind a lot of our participants over here that so far we've covered many topics across the spectrum of retirement funds, specifically, namely like retirement saving mistakes to avoid, talking about protecting our legacy, embracing the joys of investing itself, building a resilient portfolio, especially in volatile markets, comparing asset classes across, say, gold versus mutual funds, ETFs, etc. I think today we're going to probably culminate into a situation where a lot of what we've spoken about in the past, how does now one develop a strategy after understanding so many of these asset classes to ensure that you get an optimum return? Because as we age into or as we step into the life where every subsequent growth in income probably stops from regular jobs or reduces. But what tends to start happening is one starts earning by way of past investments, or one starts getting say legacy saved up investments across provident fund or gratuities or any other retiral savings that one would have done, or even have inheritance from the previous generation. So how does one kind of then take that pool and efficiently plan across various asset classes, and what should be the strategy that one should adopt for a longer term to be able to still enjoy the best years of your life? And you being somebody who's been advising many people above the age of 60, some of your clients across your 1,000+ clients are actually retired CEOs or CFOs of various corporate organizations. So who better person to guide us on that? So Mr. Sridharan, maybe you can make an opening remark and let us know how to plan and how to strategize at this phase of our lives.
Yeah, thank you for introducing me, Ashwini. When we are talking about asset allocation, or when we are talking about investments, all basically, when we are talking about investments, everybody shown on TV, they are all successful investors, is what actually come on TV. The poor investors, who has lost their money, they will not get appeared on TV channels or anything. So whether luck will play, or is there a science behind the investments will play? That is what actually, is important topic that we need to probably, take it up here. So when we are talking about science, so, when you are not feeling well, there is a science behind it. There is a chemistry behind it. Basically you go to a doctor, and then the doctor understand the body anatomy well, and then they prescribe some medicine, so which will probably cure. So when it comes to financial planning or investment advisory, that works in the financial planning and investment advisory as well. So that science is nothing but the asset allocation. So when we are talking about asset allocation, it is nothing but the investments, across various asset classes. See, predominantly when we are talking about asset classes, repeatedly, again and again, I tell the same thing. There is nothing more than 4 asset classes available for any individuals. One is actually the equity and equity based investments, and then fixed income. Then we are talking about gold, and then real estate. So when we are talking about real estate, it requires a huge investments, that is not a part of, it is not yet financialized. Though, it is being financialized in terms of REITs and InvITs, but it is yet to become popular and yet to, show its, the real return in terms of the retail investors or any investors that we are talking about. So because, the ticket size in some, AF and other things area. So we will not discuss about the real estate right now. So we will talk about the 3 major asset classes. One is actually the equity and equity based investments, and second is fixed income, and third is gold. Even the gold also is basically the a kind of paper gold that is available right now. So when we are talking about the asset allocation, it is something where we cannot every year the assets might be, say asset in the sense, the return on every asset has its own cycle. When we are talking about equity has its own cycle. When we are talking about debt or fixed income, it has its own cycle. And when we are talking about gold, it has its own cycle. So we may not be able to chase a particular asset which may be delivering a good return in a particular year. So when we are talking about the asset classes, in 2019, your equity has delivered a good return. Your debt has not delivered a good return. When we are talking about 2018, equity did not deliver a good return. But wherein the gold has delivered a good return. When we are talking about 2008, when the global financial crisis that has happened, during that year, equity has delivered a negative return, whereas gold has delivered a positive return. So, how to mitigate the risk is basically by doing the asset allocation. Invest in all three assets in a different position. Basically, depends on individual, the time horizon and then the risk appetite. They can diversify into various assets, so that what happens is we need to just, even actually, we can just invest in a particular asset allocation, and then you can sleep well. End of the day, what we need is our assets have to work for us, and we need to have a peaceful sleep. So that is what is mainly, important. At times your gold might be delivering a good return. At times your equity might be delivering a good return, which will compensate the risk that you are taking. So this is one thing, that we would recommend. Apart from that, there are two types of asset allocation that we follow. See, asset allocation, again, I can probably give you an example like a full meal. Asset allocation is like a full meal. So you can't eat one day, you can't eat only rice. One day you cannot eat only, the rotis. The other day you cannot eat only sabjis. So the asset allocation is a full meal where you need to have a kind of a complete nutritional food in the plate. It's a full thali. You have rice, you have roti, and then you have sabji, and then you have pickle. You can't eat a pickle one day for your, for your lunch. So this is the science behind the asset allocation. And when we are talking about the asset allocation, there are two types of, asset allocation that we can follow. One is actually a static asset allocation. We decide, so what is to be there on equity, what is to be there on fixed income, what is to be there on gold. This is actually static. You just invest, forget it, stay for a long period of time, because discipline is the key thing to manage your risk. So there is no luck place in this place. You just have to stay invested. Market may be moving up and down. There could be, even let us talk about various instances between 1980 till now. There was a case of this one, Ashrat Mehta scam, and then your Tehelka scam, and then your uh, you know 9 bar 11, the global, this one, the trade center hit. And then there is 2000, what do you call, the tech bubble that has happened in 2008. There is a, what do you call, the global financial crisis happened. And then there is a Brexit happened. And then there is, then there is COVID happened. Lot of things, Russia, Ukraine war. Many events have happened between 1990 till today, but still, equity as an asset class has delivered a better, the inflation adjusted return. But does it mean that, you need to have the entire money to be invested in equity? It doesn't play that way, because people mindset, the behavior is actually, works on two things. One is actually, they will be greedy, or they may be fear. So when the market goes up, they will all keep investing in equity, because that is the one thing which has delivered a good return over the past. So they keep investing when the market is high, and they sell when the market is low, because the fear will play a role when the market is low. They will wait for longer period of time, and then they try to sell the equity holding when the market is at the real bottom of the. So this is where actually the individual mindset, where the greed and fear, they will not be able to control, and hence they need to have the asset allocation in place, and then they can just stay away from all the market. This one, see, many people, they will always talk about other success and others failure. Rather than talking about other success, they talk more about others failures. But wherein when it comes to their own failure, they hide it. So that's the way actually, most of the people actually hide away from equity market. So when we are talking about asset allocation, yes, the static asset allocation, you decide how much actually, uh, how much money you wanted to invest in equity, how much money you wanted to invest in fixed income, how much you wanted to invest in gold. Invest, forget it. You just look at it, how the market is behaving. So by doing this over a long period, let's say, when we are talking about 5 years, 7 years, 10 years, 15 years, 20 years, irrespective of any number of years, this could be the better mechanism that works well for the client, irrespective of whether the luck plays, whether the market does well, doesn't do well, whether your gold, is shine or not shining. That's not the matter. This is one, one scientific approach that would work for the client. And second is the dynamic asset allocation. See, every year, don't just look at the market. Don't look at what is your portfolio, because everyone is emotionally attached with money, but still, whether it is a loss or gain during that year, you just rebalance the portfolio based on what was the asset allocation that was basically being decided at the beginning of the investments. Keep doing this on a year-on-year basis meticulously without looking at the market, because the market does not give you any clue. The market does not, even any the RBI does not give you any clue on whether the interest rate goes up or down, or when. Nobody has the clue on whether the market does well, whether gold prices moves up, whether there is a crisis that is going to happen. Whether everybody does only the postmortem work. Nobody predicts the market well in advance. So from that perspective, it is always better to knock off from the noises and have the asset allocation in place. And this proves to be a very scientific model that works for the client.
So thanks for that, the opening statement about opening remarks about a few things, and what resonates is, and let me actually remind our participants once again, is that or remind them, is that any questions that you have, so please keep putting them on the chat. We'll take it up as we go along, or take it up towards the end of the session. But please put your doubts, queries, and questions out in the chat. I like the way you said about you started off by saying that for illness we go to a doctor. What do we do for financial planning? We try and do it ourselves most often. I like what you also said, is that diversify across assets, have a thali approach, because there are inadvertent needs or unplanned, uncalled for needs that can happen. Health, inflation is anyway everybody is trying to tackle always. But it could be any other occasion. You may want to withdraw. So there has to be a full bucket of bouquet of these across these four asset classes. I like the way you said about real estate being kept out of it, and there's a separate topic to be taken. There are views around it also, as in terms of rent and own real estate itself. And REITs are a new concept which has come into India. So is paper gold now, or rather, so that we discussed in the last class. But now coming to the two strategies that you said, is the fill it, forget it, and shut it. And most of us who are from the era of the Maruti and the Bajaj scooter days, is fill it, forget, shut it kind of scenario.
In Suzuki used to have that fill it, shut it formula.
Yes. I was trying to. So that's the static strategy that you just put in for the long term and let the job be done by your savings, which you pooled in so far on its own. You will achieve some return. And I'd like to ask you pointedly, what is to be expected over there? And in the dynamic approach, where you're trying to say that, every certain period, and in the previous classes we've kind of alluded to it and covered it, that once a year you should review your portfolio. So every year when you sit on that and say that, okay, I'll reallocate my assets across, say, gold, equity, debt, fixed income, FDs, senior citizen deposits, which again is part of fixed income. So what is that one can expect between the two strategies, assuming that none of us are, and somebody's already posted a few questions around it, is that none of us are experienced enough to take direct stock exposure or don't have the time to keep analyzing. We've got to do our day jobs of just enjoying this phase of our life. We did our jobs of being at careers for a large part. So what do you normally recommend to your clients, and how do you give them that approach, that what's the base level that one should think of? What's that percentage allocation? How does it work? Something on those lines.
Yeah. See, assuming, at the age of 15, when they set aside money for their children, future, like their education and all those stuff, when they are setting aside money, and assuming, they need the money for their retirement at the age of 60, for them, they can have an asset allocation of 70%, they can have it in equity-based mutual funds. And then about 20% they can invest in fixed income products. And 10% they can invest in gold. Setting aside emergency fund of 6 to 12 months of their expenses as emergency fund. And setting aside money for their children education, because the graduation, post graduation, all those stuff will be there. So they can set aside money. Whatever the retirement purpose that they wanted to generate or they wanted to set aside, they can probably have an asset allocation of 70% equity, 20% debt, and 10% gold. This is the asset allocation that they can follow. So I have done a research. You see, basically, when we are talking about doing this, when they are doing a static asset allocation, assuming somebody has invested 100 rupees, out of 100 rupees 70 rupees invested in equity, and then 20 rupees invested in the GSEC, and then 10 rupees invested in gold. So the 100 rupees, it could have probably gone via all the market ups and down cycle. By end of 2019, I'm talking about the 20-year period. So it could have probably given an approximate of 100 rupees could have become 660 rupees. So that's a huge 6x, 6.7x of times of money that they would have probably made. So when we are talking about the ups and downs, during 2008, the Sensex was down by 49%, and then 2000, see, continuous 3 years it was down between 2000, 2001, 2002. All 3 years, Sensex has delivered a negative return. But in 2003, it has delivered a positive 63% return. I'm just talking about the pure Sensex 30. On a year-on-year basis, what was the return it is being provided? So from that perspective, irrespective of whatever, your money goes ups and down, it is just sailing across the market cycles. Whether gold is delivering good return, gold has not delivered any return during some point in time. Basically, between 2004 to 2000, sorry, not 2004, basically 2013 to 2016 or 17, gold has not delivered any return. Such a long period, it just stays with its value. It does not change. One year actually it has delivered 4% return. 1 year it has delivered negative return. But still, if you look at the return that has been delivered by gold in the last year, it's phenomenal. Similarly, all assets may not go in tandem. So from that perspective, 100 rupees invested in a strategic allocation delivered 670, that is 6.7x times in 20 years. When we are talking about the other way, like every year, irrespective of wherever the market is heading, stay put on your asset allocation on a year-on-year basis. Every year, you just rebalance the asset allocation. Your 100 rupees would have probably become 873 rupees. That is 8.7. See, the return difference is huge. The return difference is huge. So that is where actually, you need to follow the asset allocation rebalancing strategy. And hence, at the age of 50, one has to basically have an asset allocation of 70% equity, 20% debt, and 10% gold to manage the volatility and get a higher return, and rebalancing the asset allocation on a year-on-year basis would be a better this one. So that is what actually I would recommend. Another thing I would like to give a this one, the practical this one is whether the bicycle go faster or the airplane goes faster. Which one goes faster? Obviously, the airplane goes faster.
Yeah.
Right. When you wanted to travel, 2000 kilometer, you have to choose aeroplane. When you want to go only for 5 kilometer, you have to choose a bicycle only. You cannot choose aeroplane. So this actually, exactly matches with the asset allocation. When we are talking about the short-term goals, you should always, look at how fast I can reach, whether my money is safety or not. So from that perspective, you need to avoid investing in equity as an asset class, because it goes slowly, but it will reach you. It will take you to your destination. So that is something that we need to work on. And another good example I could say, which is the fastest animal.
The land animal cheetah.
Cheetah. Yes,
Yeah.
everybody knows it is cheetah.
Yeah.
But cheetah is a sprint. Cheetah, runs for 30 seconds faster. It'll probably, from 0 to 50 or 60 kilometers fast it will go. And then it needs a rest. That is the reason why, it's wait for a prey and then it catches very quickly. Whereas on, there is an animal called, the pronghorn, which is actually a kind of, like deer, like this North American deer. This actually, moves between 0 to 50, but it also goes on a sprint, and it actually, goes in 50 kilometer speed for 30 minutes. So which is stronger? So we actually, the asset allocation takes you participate on the marathon, not on a sprint.
You've actually touched something very personal to me. So I will always lose a sprint race, but put me in a marathon of maybe 20, 30 kilometers, can continuously run. But that was a question which was crossing my mind, and I'm sure lots of participants over here and our learners would be keen to know, is that you addressed the part about, one is from a risk perspective or longer term perspective, the returns which beats inflation, or the asset class which will beat inflation over a long period of time. And I think that the key phrase or the key word in this is long, is equity. And the others are again inflation hedging or adequate return, but they are meant for more to balance the portfolio for short-term needs. So if I were to now put it in a time cycle way, you are saying that the component that should go to equity should be the one that you should not be looking for exiting for how many years? That's the marathon example, right? What is the long distance that one should think as long for in the business of investing, and what is short to medium in terms of time horizon?
Okay. So when we are talking about long term is anything more than 5 years to 10 years to 15 years, 20 years. That is what we call it as long term.
So 5+ minimum. Yeah.
I would say, even 7+ is the long term. The medium term is between 3 to 7 years. That is the medium term. Anything less than 3 years is short term. But normally people confuse between the taxation with the long term and short term. In equity, less than 1 year they consider as short term, more than 1 year is long term. But this is only applicable for taxation purpose, not for the real return perspective. So on the return perspective, anything less than 3 years is considered to be a short term, and 3 to 7 years is the medium term, And then 7+ years is considered to be the long term. And when we are talking about long term again, the asset allocation one has to follow is long term is 70-20-10 is something that they can follow. 70% equity, 20% debt, and 10% they can follow. They can have gold. But when we are talking about medium term, they can have basically, they can have about 60% in debt and 30% in equity, and then 10%, maybe a little higher, allocation based on if somebody is ready to take higher risk. Maybe 50% equity and 40% debt and 10% gold also is something that they can look at it. You need to unmute, I think.
Sorry, now it's better.
Yeah.
As each one is what you said in the beginning is to each individual's status at that position at that point of time. One needs to kind of think of, even in the every individual's case, the medium term could have issues to do with, as you rightly said, that as soon as you come out of your 50s, and there are medium term expenses that may come, which is probably repairing of the house or kids' marriage or further education, etc. So therefore, the medium term at that time may require a lumpy sum because you are expected to, whereas as you settle all those things, pay off your mortgages, pay off, then the concept of medium term also will change, or the amount that you require in the medium term will also change, because then you have a foresight of, besides health there and maybe some other travel related expenses that you may want to keep aside, there are no other lumpy expenses that may be there to each individual. So one needs to then, what you're saying is that one needs to then sit down and think about it. And in the dynamic strategy, it makes a lot of sense to sit down and plan that what is in year one my medium term requirement, and maybe 3 years later my medium term requirement will also change.
Yes.
And around that time also my risk understanding and risk profile also may change for various reasons of every person. So therefore it makes a lot of sense to kind of evaluate it dynamically, and B, look at professional advice at times, and to address somebody's question in between, that you get these messages. One recommendation: don't go by any messages from people who you don't know. That's also part of our theme on the cybersecurity that we keep telling people in our community, and Get Set Up is at the forefront of it. In fact, we're just launching a cybersecurity hub and AI hub for older adults and seniors. So anybody who's keen to know what are the other things that can happen in the cyber world, go check out that hub on a separate note. But one needs to then allocate based on one's risk profile, one's need, and one's time horizon, if we were to put it in these three broad buckets.
Yeah, I will give you different perspectives. Basically, this is called as personal finance. Why it is called as personal finance is nothing but, I am giving a medicine of, somebody in the group, say, everybody is having a fever. I am being a doctor advising everybody here, addressing this, conference. I cannot just like that say, crocin is the only tablet that will cure your disease. Right. So this is where, it requires a lot of help in terms of sitting along with the advisor, understanding, and then taking up a decision in terms of what would work for you. Because, this is more personal, because, individual requirements and their needs are completely different from one with another. Even there could be a family where their brother and sisters, the advice might be completely different. It is completely tangible. It is completely tangent. So from that perspective, the generalized perspective is what actually we can talk in the meeting. But if one needs a personalized advice, it is always better to connect with an advisor, talk to them personally, and then, it is something where it might be personal to you, where you can discuss with the advisor and then take a proper advice, is what something that I would recommend to individuals.
No, fair point. In a general setting, these are large, the sprint marathon, somebody's already commented about that. That's a good example to think about, when you're planning. Individual specific needs will differ, as well as individual family situations and personal situations will differ. Again, coming to the broader part, we've been largely addressing the 55, 50 plus kind of scenario that, so far you've been mentioning. Is there also an asset allocation that one needs to kind of reevaluate, say, 10 years forward, when one is at 60, or one is at 70, or one is at 80? Is there a way of rebalancing, or is there a thought process or a recommendation that you give on rebalancing the portfolio based on you're achieving a certain milestone of age, chronological age? Will equity still be a part of the portfolio? Should be a part of portfolio? Your views?
My views is basically equity should always be a part of the portfolio, irrespective of whether you are 50, 60, or 70. Maybe by 70, you can reduce maximum towards, debt. Sorry, you can increase your exposure towards debt and then reduce towards equity. When you are turning 75, yes, you should be completely away from equity, because that time you may not be able to take too much of risk. But again, I may not be able to generalize it, because individuals who might be wanted to, last time we discussed about this, there could be a gift to income, or probably they may be in the gratitude stage, what stage they are in. Based on that only, the asset allocation may be varying, but still, in general, basically, when they are turning 70, 75, up to 80, they can have equity, not more than 80. I would say when they are in the age of 60 plus, they can have about 40% allocation towards equity. 30 to 40% allocation towards equity is still a better option, because their life expectancy goes up till 80, 85. That's a standard life expectancy based on the statistical data which is being given. So when we are talking about they're going to live for next 20 years, 25 years, so sitting in fixed income, they are slowly eroding their capital. They may not be able to beat the inflation. So on the other side, they can have about 40% exposure on equity. 40 to 50% they can have, and then slow and steadily they can reduce their exposure towards equity over a period of time. Once in 5 years, it has to be reallocated. Unmute.
My chat box keep opening, so the unmute
Yeah.
button. Sorry about that.
Yeah.
As I understood, and in the previous few classes also, we addressed some of those situations. So anybody who is keen to know more about it, please go to the Get Set Up Finance Hub, access any of this information. They are available in written content as well as articles. But just touching upon something that you just mentioned about rebalancing based on age also, there is in our markets, in the financial advisory market, we've always kind of used a thumb rule. Thumb rules are always, again, a general statement, but
Yes.
thumb rule of 100 minus age to be in equity. So at
Equity, yes.
75, your equity component would be probably less than 25%. So you're saying the same thing, that as you age, your equity component can keep reducing, but
Yes.
definitely have some part of it, because that's one asset class in the long run which beats inflation by a larger margin. Gold also beats inflation to some extent, but not with that larger margin. And also, one of the things that at this stage of life means, while one wants to keep the same lifestyle of travel, etc., you also want to kind of hedge against a particular inflation which is unknown still, is healthcare. And the healthcare inflation can be huge. In another discussion, it came across as too big inflation. Is, I think you only suggested in one of the classes, lifestyle inflation. I think you lifestyle inflation.
Yeah.
Is that 20 years back, phones were far cheaper, plus you didn't need to replace them every few years. The feature phone continued for five years for everyone. Now every second year you want a new smartphone, or you need a new smartphone because the software changes. So stuff like that is also unexpected, and hence there's a balance that requires. Maybe that's why probably is the dynamic asset allocation comes across as a far more vibrant, because you are on watch of what's happening to both lifestyle inflation, health inflation, and general other inflation. While at this stage, your other needs have gone away because you no longer are paying mortgage, you no longer are paying for education of children, etc., etc. You know, they would have finished off, and your responsibilities are largely over, but other expenses take over. That's an interesting facet of age versus equity exposure. I think we'll start taking some of the questions in the chat box, but I had one more topic to touch with you. You consciously mention only financial assets. A lot of us are also have two or three physical assets, which are very emotionally to us, and we consider them as assets to be passed on, as well as even as earning assets. One of them we discussed in the last class was gold specifically. We touched upon it, and we explained the merits and demerits and of physical versus paper. Uh, what's your quick view on a house that everybody wants to own, a real estate what everybody wants to own or has owned because you've saved up for it, a second home, especially for your children, which you want to leave behind, not necessarily the one you're living in? And is that calculated in your strategy of asset allocation? You kept it aside in the beginning.
I have kept it aside in the beginning because you cannot rebalance your physical assets. Okay, so you cannot rebalance, but from the overall perspective, real estate as an asset class, one should have for living purpose. Yes, this can be discussed as a separate topic because lots of ifs and buts, and then what is everybody has emotional attachment towards the property, and then they hold for long period of time. It is not something where they will basically hold for short period of time. And secondly, they buy a house for as you rightly said, gifting to their children. But the dynamics of Indian, family system is changing now. Earlier, actually, they used to move within the city or within the town. Now, actually, people are shifting away from the country itself. So your child might be sitting down today, may not be there here, and the kind of dynamics that we are seeing right now, the entire world is actually we are able to access maybe after some time without any visa. That's something that may probably come after some time because of the population is basically being reduced across the globe. So we can discuss this as a separate topic, and then we can mind blog on whether property is good or rental income is good, or probably not even having a house, and then uh, you know uh, only living with the rental income. Rental house is good. All these mind blogging think that we can have it as a separate session, because we don't have time for doing that along with this session.
No, a good point, and I think I didn't even realize that somebody's already asked that question, because and then I was looking at the chat box and I saw that somebody's already asked about real estate. So that's a lot of us are thinking on those lines. So we'll do a separate topic someday on that, and stay tuned to Get Setup's webinars. We'll do a separate topic. We also got some comments saying that sessions like these are informative, and regularly do it. So again, encourage people to get on to Get Set Up app, and be regularly post not just financial content, but anything that the community is always looking out for, learning from your own peers. So it's a peer-to-peer model of learn from each other, engage and socialize. So lots of similar content across finance, across health, across engagement, across cooking, skilling, anything that is interesting. So just log on to Get Set Up. I think some of the things that you said, Mr. Sridharan, is all about staying long. would you, and there I can see, I think people are thinking, or we are thinking alike across on the cyberspace. What would you and how would you rebalance in the form of, one is taxation, but when you rebalance, do you sell, liquidate, use up, or when do you do it? Because when you say long term, I could just keep doing a systematic investment plan for 30 years, but when do I use it? So is there when you're advising your clients, do you how do you kind of get them to strategize, to think that how do they extract the value of their savings, which has now multiplied or which has now got parked into various investments, to keep doing that? Any thoughts on that?
When we are talking about you know taxation, taxation is something which we cannot avoid on any asset classes that has been set right now. So earlier, actually, before 2018, the taxation on equity was only short term. Long term capital gains were basically it was not there. So, but still, even after considering the taxation of 10% on equity, still it is wise to do the rebalancing, because we are just paying 10%. See, when you are earning your income of, let's say, about 10 more than 10 lakhs, the old regime, you're still paying tax of 30%. Even you are paying a tax of 30%. Here only on the growth you are paying a 10% tax, and that does not have any major impact. That may probably reduce your profit by 10%. So when equity is delivering, let's say, about 13% in a year, of 20% in a year, then only your asset allocation will be tweaked towards equity. So otherwise, there is no rebalancing that is required. When you are earning 20%, paying of 2% tax is not an issue for the investors, basically, because if you stay invested, anyway the market erosion will eat away the profits, right? So from that perspective, don't look at the taxation. You can still do the rebalancing. That's number one. Number two is, when we are doing the financial planning, we set milestones. When the milestones are hit, not the milestone, when the target is hit, you just get away from the market, equity market. Stay away. Assuming you plan for an investment period of 10 years to achieve the financial goal that you are already created. Assuming after 5 years or 6 years, if your goal is being met, if your goal amount is achieved, stay away from equity. Simple logic with which actually one kind of a rebalancing that can be done, irrespective of wherever the market is moving. My objective is being met. Get away from the market. That is another kind of rebalancing. There are various ways of rebalancing that can be done, and one is actually, once your target achievement is done, get away, stay invested in the what do you call, the safer asset class, exit. And second, every year you can do the rebalancing. If not, when there is a quick rally that has happened, instead of our the written based asset allocation rebalancing, when we are setting a target of, let's say, equity 12% and debt is 7% and gold is 7%, when the equity is delivering 20% in a year, rebalance it during that particular year alone. That is another way. Third is actually, irrespective of wherever it is moving. So there are various strategies. Depends on individual again. Again and again I come back to individual, because something may not work for everyone. So from that perspective, it is better to have your target fixed, and based on that you can do the rebalance.
You actually added another facet. So basically, rebalancing of the portfolios is one is on a time horizon basis. The other is across, of course, asset class basis. You touched upon now is objective goal based or return based rebalancing.
Yes. Yes.
So start with a certain thought process across asset classes, and you've classified them on four major ones, and then rebalance based on, if you had a target of, say, 13 to 15% in equities, it's been achieved, exit, and again rebalance it. It's a combination of things which requires you to, therefore, would you strongly recommend, or would you recommend the dynamic asset allocation or dynamic strategy, or even or the static one, which is probably lazy people like me would just fill it, forget it, and shut it? Which one would you bias yourself if there is?
See,
Again, on a
basically,
general rule basis, of course, each one is different.
on a general rule basis, I would say, static asset allocation, fill it, shut it, forget it. So even in my in my WhatsApp status, I always have plan, invest, continue. That's it. So the reason being, many of the investors are busy occupied with their own work, and they don't have even time to look at whether their money works for them or not. So from that perspective, they can just do a static asset allocation, fill it and forget it. If someone needs to review it on a regular basis, then probably, instead of just doing every year rebalancing, at least, once in 2 years, once in 3 years, they can do the rebalancing of the asset allocation is something that they can do it. I think you have to unmute again.
No, now I'll permanently keep it on mute. Now I start reading the chat and some questions on that. So I think a lot of it is already covered. Maybe somebody just raised a question. I don't know whether you want to address that. Is that with AI coming in, is there anything that is going to happen to financial planning for individuals? Interesting, because as an IFA, is that going to disrupt your business?
Yes. It is never the case. See, basically, when we are talking about, again, the AI cannot replace the emotional, touch that the investor has, and the AI does not, have a kind of, touch and feel. See, basically, as an advisor, we are not managing your money; we are managing your emotions. When the market is not so great, you may be trying to sell the AI will probably give you a hint on what you need to do. Whether you are going to react or not is something that is depends on individual action. So the action has to be influenced by the advisor. If it is not influenced by the advisor, definitely the individual will not make a decision, and definitely, there are a lot of robo platforms and all, a lot of online platforms that has come in, but still the contribution that has come from the IFA community or the advisor community contributed to the growth of the Indian industry is very huge. It is phenomenal. So by this time, when the online platforms have come in since 2000, I think the first platform that has come in 2008, that was where actually I started my online advisory services. So even when it comes, I know that was considered to be the disruption model, but actually it did not disrupt. Because of that, actually, it is easy for us to just execute the transaction. But the advices, basically, every individual has unique requirements. That is the only reason why we cannot apply an artificial intelligence in terms of they may be selecting the good funds, they may be selecting, which script to buy,
So,
but not replacing.
so even if you're using the AI platforms, you still require an independent financial planner or a human planner to kind of know your need to be able to
Exactly.
your need or your risk profile or your this thing, because machines will still take a time to be able to fully understand everybody's personal requirements. So I think that question gets answered. Somebody's quick question, and I think we have 2-3 minutes to take a quick questions from the chat. With some of them, most of them got answered as we were speaking. But a very direct one is that somebody is in the 70s and has 50% exposure to equity, and has, of course, generated alpha of a couple of times in the last few years, especially. What should we do? Book the profits and exit, or any other thought? I would probably, if by now my learning with you is, I would say rebalance.
Rebalancing is something that I would recommend. See, basically, exiting away from equity is not the right approach. And I am not here to, predict the market where this market heads towards this financial year.
Tomorrow morning for that matter.
Tomorrow morning, yeah. Even tomorrow morning, or even for this year.
Yeah.
When we are talking now, if you ask me, where the market is heading by end of this year, by December, I am not here to, predict the market. I am here to provide you a scientific approach. At this juncture, yes, of course, the last 3 years it has delivered a good return. Maybe you can do a kind of rebalancing the portfolio. Is something that I would.
Yeah, that's why it's always urged, and once again, at the cost of repetition, is that individually everyone is different. Just like Mr. Sridharan said in the beginning, is that for illnesses we use a doctor, we go to a doctor. So please do consult your independent advisors accordingly, or somebody that whom you trust and who's experienced enough to guide any one of us. Even in the kind of questions that is about long-term capital gains, etc. Again, it depends on your overall tax structure, not instrument based, because there could be some advantages, disadvantages of booking long-term or short-term. So that again, please, it's recommended that you take a tax advisor's advice, because whatever we speak on the platform is more for general learning and strategy. Individually, I think one of the things that we've always done is, if anybody is keen to get in touch with Mr. Sridharan or get set up for, please do write into us or get in touch with our customer support, and we can guide you accordingly. More content like this, more advice and learning from your own peers is available, will be available. Come, join, get set up, and enjoy both learning and engagement in a peer-to-peer platform. Parting remarks from you, Mr. Sridharan, and thank you very much. Parting remarks from you as well.
Yeah. Thank you.
I think there's a form that's been circulated. Abhijit, maybe you can post it again quickly. The form's been circulated by Abhijit by Get Set Up, so please do fill it in if you feel like getting more content like this regularly across, as we said in the middle of it, whether it's even cybersecurity or AI related stuff, or whether it's any of your interests in cooking, singing, photography, dance, or of course health and wellness and financial planning as well. So get in touch with customer service at Get Set Up, and join the community and keep learning and keep enjoying. Thank you, Mr. Sridharan, for a lovely day. Thanks. And thank you very much to Franklin Templeton once again.
Yeah, thank you.